This is a look at gold markets on May 9th, 2026. On Monday, silver traded under $30 a barrel, which marked the lowest level since the start of 2026. Spot gold is consolidating near $4,700 to $4,720 per ounce. The market remains in a state of precise equilibrium. After a sharp 10% fall since late February, gold is now up more than 2% this week. Technically, the short term reads bearish near moving average resistance, while the long-term bull trend holds. Three forces are shaping gold: geopolitical shifts, central bank and ETF flows, and monetary policy uncertainty. Tensions in the Middle East have eased as optimism grows about a potential US-Iran peace agreement. Despite recent skirmishes, both sides have signaled a renewed interest in maintaining the month-long ceasefire for now. A formal deal could reopen shipping lanes, lower energy prices, and ease global inflation concerns. Paradoxically, lower risk appetite reduces safe haven demand, while an improved rate outlook supports gold long-term. The U.S. Federal Reserve remains the wild card, with markets watching jobs and inflation readings closely. Recent NFP and CPI data indicate resilience in the economy, while inflation has accelerated this year. Markets have largely priced out rate cuts for 2026, pushing pivots toward late 2027 or 2028. The US dollar index sits under the 99 level, where a sustained breakdown would be a major tailwind for gold. Structural demand from central banks and ETFs remains the bedrock of the gold market today. It is the silent anchor in an age of digital volatility. Deutsche Bank suggests gold could reach $8,000 if emerging central banks increase gold allocations to 40%. After months of consistent outflows, global gold ETFs saw a decisive shift back to inflows in April 2026. This movement signals a fundamental return of institutional interest. The tide has turned. Traders are balancing headline risk with technical levels, while watching order flow closely. Analysts are framing bullish and bearish scenarios with precise price targets and technical catalysts. The bullish case targets 4,890 to 5,000 on a reclaim of the 100-day moving average. The bearish case points toward 4,500 to 4,410 if resistance holds and lows break. Key levels to watch include the inflection band around 4,700 to 4,720 and the May 8th low at 4,674. Market sentiment is choppy, oscillating between risk-on optimism and risk-off caution, depending on headlines and data. In the short term, expect choppy, sideways trading as markets digest diplomatic developments and data. Upcoming macro releases and central bank meetings could rapidly shift probabilities in either direction. The market stands at a critical juncture. Institutional flows matter. ETF inflows in April reflect renewed interest among large allocators. Central banks accumulate gold as a long-term hedge against currency risk and geopolitical uncertainty. Emerging market central banks increasing gold allocations would materially change long-term supply and demand dynamics. Physical demand from refiners and vaults provides an additional pillar supporting prices under stressed conditions. In a market defined by volatility, these tangible assets remain the ultimate standard of security. Supply is not infinitely elastic, and mining responses to price shifts take time to materialize. Macro risks include renewed conflict, unexpected inflation jumps, or sudden policy shifts that could affect gold sharply. Finally, Market participants are running scenario plans and hedges to navigate the current uncertainty. The strategy room remains quiet, yet the implications of these calculations are far-reaching. Risk management and position sizing are critical, as volatility remains elevated in gold markets. Short-term choppiness should not obscure the structural reasons many investors favor gold for the long term. Tactically, watch the inflection band, the DXY, ETF flows, and central bank announcements closely. Long-term, gold maintains a role as a hedge against currency depreciation and geopolitical risk. Quantitative models offer varied paths, but many show upside if structural demand persists over 5 years. Central bank actions are deliberate and driven by reserve diversification and long-term stability goals. Headlines will continue to move markets, often amplifying short-term volatility in either direction. Each diplomatic update and macro print shifts market-implied probabilities for rates and commodity prices. As the data evolves, so too does the landscape of global finance. Let us recap the current market outlook. In the bullish case, the index reclaims its moving average, targeting a range between 4,890 and 5,000. Conversely, the bearish case suggests a decline, pulling the market down to between 4,500 and 4,410. Actionable signals include a decisive reclaim of the 100-day moving average and a sustained DXY break below 99. Investors should set clear risk limits, diversify, and monitor central bank and ETF movements closely. Macro moves in gold and energy ultimately influence everyday households and businesses worldwide. In summary, expect short-term choppiness, but remember the structural factors supporting gold over the long run. Gold sits at an inflection point where geopolitics, policy, and structural demand will decide its next path. If you found this analysis useful, please like, share, and subscribe for more market documentaries. Subscribe to stay updated on market developments and deep dive analyses into precious metals. Thank you for watching. Stay informed and trade responsibly in uncertain markets.